Daniel Ang and Calvin Wong, they come to our in-person meetups often. I think the last one we had 50, 60 people, and it felt like maybe half of the people Daniel and Calvin brought. So we appreciate that. They have a big team and a big network. So yeah, if you guys want to, talk about your background and what you guys do, and then we can go through the presentation.
Yeah, appreciate everyone being on the call and just kind of learning, right? With the shift in the market, always prepare yourself, get on these calls, learn more things, right? Diversify yourself in any aspect of commercial real estate. Back in 2008, Calvin and I met at CCIM class. That's our commercial certification for real estate investments. And we met at that class during the downturn, during the shift in the market again, right? So my background has always been commercial real estate on the retail side. So that's why our focus is going to be some retail investments. Graduated from college in Switzerland, studied banking and finance, and and Calvin will talk about himself. But we've been business partners since 2012, and we have a brokerage team, we have a development group, and we have just different things that we're building up as we prepare ourselves to shift in the market for 2023. So, Calvin.
All right. Good evening, everyone. My name is Calvin Wong, and just a little bit background myself. I started out of college. I worked for Goldman Sachs for 7 years, and actually met Daniel in a commercial real estate class, CCIM class, back in 2008. And become friends, and I've been talking. And then 2012, so 4 years later after I met him, I quit Goldman to partner with him. So really, expanding the brokerage services, helping our clients buying and selling commercial properties. And in the meantime, we also look for opportunities to acquire for ourselves. So Dan and I, we've been partnered for 10 years, and we also acquire retail assets for our own investments. We also have a leasing team and property management team. We are managing about 1 million square feet in mostly retail centers. We also have some warehouses that we are managing as well. Really, my prime focus is in retail and industrial and land development. So happy to, if you have any questions later on after our presentation, happy to kind of go over anything that you guys want to talk about. And again, thanks Nick and Yoshi for this opportunity. All right, I always like to kind of gauge the audience. How many of you guys own or investing in retail assets already? Let me look at.
You put it in the chat, or feel free to unmute yourself and speak up.
Or give us a thumbs up in the reactions.
Anybody? No one's invested in retail shopping centers? You guys are missing out. Yeah.
Lots of movies.
Yeah, no, thanks for that, because I always like to see like majority of the audience kind of like the knowledge or skill sets, because I don't want to go too deep that everyone just like fall asleep and it's like, oh so it's good that we most of the audience are pretty fresh about retail, which is great. Second questions, who do you guys think that Amazon or e-commerce is going to kill all the retail centers? What's your thought about when you look at retail? When you think of retail, you'd be like, oh man, like it's definitely kind of going down, and it's like no one, because Amazon is taking over the world. Like, any thoughts about that?
I guess it depends on the classification of the retail, as you've shown in the slide.
Yeah, great. So that's kind of like, I'll kind of transition into my discussion. So there's different type of retail. Retail is a pretty broad category. Typically, we kind of separate it by 4 major categories. So if you look at the screen on the top left corner, so this is what a typical grocery anchor centers. right? So you have the Whole Foods as an anchor, and then you have the inline space, like the smaller space, that are feeding off the traffic coming from Whole Foods, right? Because everyone needs to do grocery at some point, in a week. So usually grocery is the food traffic generator. They bring in traffic to the shopping centers. And that's why the smaller retailers, they feed off the traffic. So usually, you see a lot of like Thumb Thumb, Kroger, right? They're the anchor. And then you have the inline space. And the inline space, usually you have the kind of like the national brand name that you're familiar with. Massage Envy, maybe some dentists, or maybe some restaurants like, Subway, or, the national brand name. So this is what we call a grocery anchor center. Next, we have your freestanding retail building. So your freestanding single tenant retail building is usually just one tenant, right? The fast food chain or the coffee shop. So this is what we call a single tenant. And usually the single tenant center is operated or leased by a national credit tenant. Usually a national credit tenant, the reason why they say national, because they are more credit worthy, right? They have a bigger balance sheet. And because of that, investment into this freestanding retail, freestanding, QSR, the return is lower. Why? Because it's very safe. That's why the return is lower. Because if Chick-fil-A decided, let's say they sign a 10-year lease, if they decided to shut down the store, guess what? Your lease is still enforceable. You can take them to court or settle. So in other words, usually they'll keep on paying the rent until they figure out what they want to do, or they'll give you like a lump sum and try to settle. So that's why when this type of, we call it triple net investment, right? Triple net, I'll type it in the
I
chat
muted it.
box.
Sorry, Laura, I had to mute you.
So yeah, so this is the triple net, right? Triple net lease or triple net investment. This is what we talked about. And usually the cap rate, so Chick-fil-A, the cap rate is at somewhere from 3.5% to 4%. So what that means is you can look at the cap rate as your return of your money. So it's pretty low, right? But it's safe. Typically, people who bought or invest this type of property are usually investors that are couldn't take any more risk, right? They are in kind of like in the older phase or whatnot. They pretty much just say, hey, I want like safe investment. As long as I can preserve my capital and maybe make a little bit of a return, I'm fine with it. At the bottom left picture, this is what we call like a neighborhood strip centers, multi-tenant neighborhood strip centers. What it is it is not going to generate traffic from people driving 30 minutes or an hour away, right? Not like the mall where typically people will drive 30 minutes to go to the mall or whatnot. So this is the neighborhood strip centers. Basically, satisfying the demand in the local neighborhood, right? Because who drives like half an hour or 45 minutes to get a Starbucks? No one, right? People just want to just drive like 5-10 minutes to go to Starbucks or get a haircut or get the nails done. So this is what we call the neighborhood strip centers, multi-tenant. And then on the bottom right, so this is what we it's the mall, right? So based on my experience, the big box and the big malls are the ones that threatened by your e-commerce, your Amazon. These days, if you go to some of the malls, like half of the space are vacant, right? Even with Stonebriar Mall, I mean, as busy as they are, right? Because they have, the theater, they have, restaurants and all that, but they still have a lot of vacancy. The reason why is because consumer behavior shifted. Because if you look at, your doorstep every day, you probably have different boxes piling up in front door, right? Because we all are buying products online. We no longer just go to the mall and say, oh, I want to buy a shirt, let's go to the mall and things like that. So that's why the big boxes and then the big malls are in high risk. And what we are focusing on, and we always have been focusing on, is the multi-tenant neighborhood strip centers. Remember COVID? COVID caused panic in the markets, like, oh man, like, retail, because everything is locked down, right? So people are panicked. People are like, it's like, oh man, retail is just doomed, like doomsday, whatever. But luckily, Texas, we're in a good position. So we were closed down for like 2-3 months, and then everything just kind of started bounce back and back to normal. So if you think about it, this type of, so focus on the lower left picture, the multi-tenant retail centers. So they are the ones that actually is going to thrive, because going back to our, human behavior, we like to socialize. We like to go out and kind of buy a cup of coffee, and then, people watching or meet with people and things like that, right? And even restaurants. So the typical demand for neighborhood strip centers are your coffee shop, your dentist, your nail salon, your hair salon, and then maybe like a small convenience store and whatnot. But if you think about it, all these businesses, they are either personal services or experience, like restaurants, right? Experiential. This type of services are not replaceable by Amazon. Not yet. Amazon may go crazy one day and say, hey, we're gonna start like a mobile salon, right? So they'll send out all their vans and then like put like all the hairdresser in there and then just go to people's house and mobile, right? Or even in your workplace. But not during this time yet, right? So we still have to go to this type of strip centers to get our hair cut, get our nails done, get pampered, right? Go to massages, get a cup of coffee and go eat. And that's what we were focusing on. And right now, I mean, retail is still pretty strong. But of course, the major 4 commercial property types is your multifamily, your industrial, your office, and retail. Multifamily and industrial are still the top 2 property that investors like to invest, right? I mean, obviously, some of you guys, or Yoshi and Nick, you guys are in the multifamily world for quite some time, very experienced, make a lot of money out of it. It's still going to be one of the best investment property type, and same as warehouses, industrial. Why? Because the demand for warehouses is increasing due to e-commerce, and small businesses no longer need like retail space. They just want like a small office with a roll-up door so they can put their equipment and stuff. But neighborhood strip centers is also very attractive, just because those retailers, those tenants, demand for the retail space is pretty strong, right? As I just mentioned, only the personal services and the restaurants. And one of the main difference between commercial properties as a whole versus multifamily is the lease term. Usually the lease term is somewhere from 3 to 5 years, and there's always a built-in escalation every year. So for example, like they may bump a 50 cents a foot every year, or like $1 or 4% or 5% increase every year. So that built-in escalation kind of help the stability, right? So you can really underwrite the projects, the stability of it, plus you get the rent increase. So these are the 4 major property types. So I want to stop here for quick seconds and see if there's any questions so far. about all these property types?
I think Nathan had a question regarding the single, single standing restaurants.
Yeah. I was just I think you answered it in the chat, but yeah, I was just wondering if they're typically done with like, I don't know, I feel like a different investment might be done over, let's say, a company who may lease it out to like a brand new restaurant versus something a little more established that has like franchise opportunities where you can have a little more of an expectation of like what's going to come in because of the popularity of the restaurant.
Yeah, so a lot of them will go in, so the developer will come in and secure the ground lease, and so say like Popeyes, Calvin and I are working on Popeyes. So we have a lot, the developer, I mean, the broker came in representing Popeyes because they're looking for 20 locations to open up, and they identify our site to put a Popeyes at. So when that builds out, because they're investing in building the building, I'm just leasing the ground. I can sell that property, because of the rent, because it's a 15-year lease with another 15 with option, things like that. That's what you're selling. I can have another lease where I can build the property, put a local regional restaurant. It may not sell because of risk, because it's not a national corporate guaranteed or corporate chain, right? So.
Okay, great. Thank you.
Thank you.
That's helpful.
Okay, let's go to the next slide. I think Nick just
He just stepped out.
um,
So going back triple nets. So another thing, since you guys a lot of them are either single family or multifamily, is the pass through, right? In a retail center, we have these triple net leases, and I think Calvin kind of mentioned it. Is things are passed through. We have a base rent plus a triple net rent. So what happens when the property taxes increases? Well, you're going to reconcile your accounting, and you're going to go back to the tenant and tell them they owe extra rent on property taxes. If your property insurance goes up, same thing. It's all passed through the tenant, and that's why it's much, for me. I like the retail side than the residential type leases. So, but Nick, can you go to the next slide? Nick, you there? Okay.
Sorry.
No worries.
Someone come to my front door.
Oh, don't worry.
Here we go.
Perfect.
all right, thank you. Okay, so if you guys invested in multifamily, so same thing, there will be a cap rate component, which you guys are very familiar. So this is kind of like a quick, usually I like to kind of, have audience participate in it, but given now it's like 7:26, pretty sure it's kind of too late to do some math, but this is the calculation. So, and cap rate is equal to NOI divided by price. Price is equal to NOI divided by cap rate. NOI is basically a different variation of calculation, but so really cap rate seems like the most talked about or discussed in commercial real estate, right? Everyone's like, okay, what's the cap rate of this deal? I'm looking for cap rate of over 8%. Can you find me this kind of deal? So I just want to, I know a lot of you guys are familiar with it, but cap rate, aside from the calculation, it's basically it's a snapshot of the current return. It has nothing to do with the future. It's just a current snapshot of how the property is performing. So for example, if the cap rate right now is 6%, so what that means is if you pay cash entirely, this is your current return of 6%. Now keep in mind, how you manage the property makes a huge difference in how much you're going to make in the property. So for example, I mentioned that some leases, they have built-in escalation every year. So in other words, let's say the cap rate right now is 6%, but every year the rental rate increases based on whatever the lease stipulated. So your cap rate is gonna keep on going up because of your built-in rent increases. Also, same thing like multifamily. Retail, we also have value add. What that means is you can either rehab or renovate the center and continue to push the rent higher to get that value add component. So the process is no different than what the multifamily strategy is. It's just dealing with different property type, and also almost all the retail centers are triple net leases. So the triple net is the NNN, is net of property tax, is net of property insurance, is the net of CAM, which is common area maintenance. So what that means is, if it is a triple net leases, if there's any increase in those expense, you actually pass it through to the tenant. So every year we do a triple net reconciliation. What that means is we'll look at how much we have spent in expenses and how much we have collected from the tenant, and then we'll do some adjustment. So if we collected less than what we actually paying out in those expenses, we can go back to the tenant and say, hey, send them an invoice and show them all the numbers. Let's say the difference is $1,000, then they are responsible to pay us back the $1,000 so that they are fully paid in the expenses. And that's one thing that we liked about retail, is because the tenant covers all the expenses, including property management fee. The only downside you won't get it back is if you have vacancy, because let's say you have 10% vacancy, that means like there's no tenant to pay the 10% of those expenses, right? So, but when the property is fully leased, then you don't have to worry about the operating expense, because everything is going to feed through from the tenant. So the tenant will write you a check with the rent plus the triple net amount. Does it make sense? Okay.
Hey, Calvin, just
Yeah.
a question. So since we had this rapid increase in interest rates since March, the spread between Class A, Class B, and Class C multifamily has widened to like more normal levels. There's still a gap between buyer and seller, but what have you seen with the rapid rise in interest rates in retail? What impact that's had on cap rates, retail cap rates, strip centers?
Sure. Yeah. So historically, cap rate moves along with the interest rate. So when interest rate goes up, cap rate goes up, right? So interest rate is kind of like your cost of capital. So let's say I'm a buyer. If I'm borrowing at 7%, and if the cap rate is 6%, so that means my borrowing cost is much higher than what I generate the return from, right? What we are seeing right now is seller hasn't really adjust or reflect the current environment, because the seller still can kind of hold it for some time until if market really change drastically, then they'll make some adjustment. So, but what I'm seeing more and more is for those properties that are under contract, and when the interest rate goes up, the buyer will come back to the seller and want, basically retrade the deal, because otherwise they're not going to make any money. Yeah. So I'm seeing more and more deals that the seller are more acceptable by reducing the price.
Hello. Hi.
Because
that's the expense you can't recapture right there.
If they don't, then they have to put it in a market, then they're going to go through the same thing again, because buyers going to be like, hey, there's no way you can sell at this price. No one's going to buy it because the interest rate is so much higher. But we haven't seen like a whole lot of that, but it's slowly coming. One of the reasons why is because there's still a lot of 1031 exchanges out there. There's still a lot of capital out there. However, I just got back from New York. I was talking to some of the hedge funds. Pretty much they're taking the rest of the year off because they don't feel like they couldn't find any deal, or they don't feel like the seller is, willing to be realistic. So a lot of big funds, they're just kind of say, hey, let's throw in the towel and just see what's going to happen in the market. They'll still look at deals, but unless the deals like provide like a significant discounts from what the previous expectation, then they're not going to do anything. So
yeah, we're hearing that from some multifamily brokers here in DFW. They're just kind of pencils down because the capital markets are so disjointed, and seller and buyers' expectations are so disconnected.
Yeah. Next slide, please. So I just want to walk you through a deal. Sometimes the not so good looking property are the one that's cash flowing, right? Same as multifamily. I mean, you guys have been multifamily long enough. You guys know that, hey, the exterior or cosmetic stuff, those are easy stuff. But if there's like opportunity to value add and whatnot, there's definitely money to be made. So a lot of time, when people look at, oh man, this property looks so old, this property looked like so, one of the reasons is because they may not realize that how easy it is to repaint a building, refacade, push the rent out, and that you can refinance and recapitalize. So this is a property in Irving. It's a older building, but it's in a great location. It's there's a big concentration of Hispanic population. So if you look at some of the tenants, they are, like the insurance, like basically catering towards certain demographics, and the salon, and some of the stores, things like that. So don't be afraid. Sometimes if you look at retail strip centers like this, don't feel like I'll pass on it. Sometimes these are the one that's worth taking a second look. Next slide, please. So this is the rent roll. So you have all these different tenants, the size, when did the lease start, the rent, and things like that. So I wanted you to look at the very last column, the price per square feet per year. So we quote rental rates annually. So let's say the first one, $23 plus triple net. So that per square feet, right? But that's per year. If you divide it by 12, you get the per month per square feet number, and then you just times the square footage. That's the rent that the tenant is paying. So if you look at all the last column, you see all the triple net, and then oops, you have some that's gross lease, and then the very last one you have a gross lease. So some of the rent roll you see, like maybe half of them are gross lease, or even all of them are gross lease. These are very common in like much older property, because in the past landlord was just charging a gross rent, and for a reason. So that's where there's an opportunity, because the strategy is to go find those properties and then convert them into triple net leases. Remember, the triple net is addition to the rent. In addition to the base rent, they are paying their portion of the property tax, the property insurance, and common area maintenance. So when you convert those into triple net, we all know that property tax, property insurance go out every year. This is an insurance for the landlord that if there's an increase, everything's going to pass through to the tenant. So the tenant bears all the increases. So what does that mean to landlord or owners or investors? That means you got protection on your cash flow, right? You're not afraid of expenses going to eat in your cash flow. Even if there's a higher, if there's increases in expenses, the tenant will reimburse those increases. So by converting from gross lease to triple net, you will actually get much more cash flow. And then also some of the things that I looked at when I look at a deal, I'll look at the lease. When does it expire? Or is there a month-to-month leases? Because that's where you can renew the lease or put a new tenant at the market rent. A lot of time, retail centers, I'm not sure about multifamily, but retail centers, some of the retail centers, especially here in Texas, are owned by West Coast or East Coast investors. They are not in the market. They are like in their own market, right? So they don't necessarily know how the market has overperformed. The last few years, the rent growth has been high single digit, some even double digit, just like multifamily. But if the owner is in West Coast and then they have, yes, they have property manager, they have leasing agents, but they may not necessarily like put the pressure or like max out increases, right? Because all they want to do is just get the deal done, right? Most of the time. And that's where there's the inherent opportunity. And sometimes like, you know, some of the investors, they just property manage themselves like from their hometown for whatever reason. And they may not know, okay, they may still just keep on putting like 3% increases or 4% increases every year, whereas the market already gone up 10, 12, 15%. So when you go buy this property, look at the rent and compare with the market, just like multifamily. You compare with what the market rent and then see if there's value add component, whether you can push the rent to market and things like that. I really like those centers where it is a month-to-month lease, and then or it has leases that's coming up, you know, in a year or two, because I know that during this time period I can go in, inject capital, repaint the building, rehab it, and push the rent up and find a better tenants. Because sometimes when a property it's owned by an owner for like 20, 30 years, you have tenants that have been in there for like just as long. And fast forward today, those tenants may not be the best quality or the best suitable for your center, right? That's why doing a good tenant mix will make a difference to the success of your property. You probably seen, you know, some of the center in your neighborhood that's going through, you know, renovation, and then they kick out the tenant that don't really belong them, right? Just for example, like Deep Ellum, right? Think of, most of you guys probably, you know, been to Deep Ellum before. Look at Deep Ellum, you know, 15 years ago versus right now. You know, the tenant mix are different. Developer are putting a lot of money to develop it and attracting better quality tenant, higher quality tenant.
Calvin, I negotiated with my wife. This thing was going, take the kids.
Yeah.
It still didn't work. They still came in. But yeah, she wants to be on camera.
Yeah. So so on a typical like retail value add projects, the target IRR is very similar to multifamily. We're targeting 15 to 16% IRR. Holding period, same thing, 3 to 5 years, depending on the cycle. Pretty much the process, the underwriting is very similar, right? And even the holding period and the target return. So the only difference is just the property type, and the dynamic is much different, because on multifamily you're dealing with credit score of the tenant, but in retail we don't really look at credit score. We looked at their business plan. We looked at the financials. The financials means like the tax return, the PFS, personal financial statement. And then if they have really a good business plan, sometimes landlord will give them a chance. We don't, when we say credit, how's the credit of tenant, we don't actually meant by what's their credit score, right? Because that credit score, it has less impact on their ability to pay, because the ability to pay is tied into the business, whether the business is going to generate enough revenue to pay the rent. So that's why when we looked at retail, we looked at their business plan. We have a new tenant that is interested in leasing a space. We looked at different factors like what I just talked about. Yeah.
Calvin, I was gonna say it looks like you might have bought this through COVID based on the lease end dates, some of these lease end dates, right? When did you buy this property? Or is this a deal that you brokered?
So this was bought actually with a group of investors pre-COVID, and they were on, a lot of them were gross lease, and we had a lot of vacancies. And then during the financial crisis, 2008, we actually leased it up on a lower rent. But at the same time, because it was a pretty good deal at the time. The investors are happy; they're getting their cash flow. The only thing is nobody wants to inject more capital to re-facade, and things like that. So that's why this property is actually has the opportunity to get sold or buy out the partners, so we can inject capital. When you guys are doing multifamily, you guys are pretty much cookie cutter, right? You got a little residential. You're going to put granite tops. You're going to put the vinyl floors or whatever. Everything's pretty much the same. With retail, you got to figure out, okay, if I inject this much, how much rent increase can I push? So you have to look at the market and look at what everything else is. And of course, sometimes you have to kick out the tenants. Some of these investors, they don't want to move tenants out. They're happy with them. They're satisfied. But if you have other investors that come in like, hey, I need to, I'm paying this amount of money. I'm going to move tenants out, re-tenant the property. And this is what we call value add. So even though it's pretty much fully leased, there's still value add, because you're looking at the rents are still very low compared to the market.
Makes sense.
And what's the process? How long it's going to take to turn these tenants and bring up to like $23 per square feet? Because some of them are $6, some of them are $7.
Yeah. So if you look at brand new developments, if you look at a shell space, a lot of these developers will give TI dollar amounts, tenant improvement dollars, to bring in a larger tenant, because they're basically paying for some of the finish out, right? So if you want to increase higher, you're going to have capital to also inject TI for tenants to come in. If you want to remove some of the restaurants or create a restaurant, you got to build some infrastructure for improvement. So yes, those are all possibilities, because if you look at the market around Beltline, that area, the rents are, can be from $16 to even $25 a square foot, depending on what type of tenants go in. So this strip center consists of 7 buildings. It's not all facing Beltline, so it's a little bit in the back. So that's why the rent is lower. It's affordable for small retail mom and pop tenants. Everyone's been there for a long time, but there's different options you can do. You can tear a couple buildings out so you have more frontage. So there's different ways to look at how you want to, if somebody wants to come in and reface and redevelop this whole parcel.
Yeah, but a typical strategy is just look at the current rent roll, look at the current lease expiration. Yoshi, good observation, right? The tenant is paying like $6 a foot per year. That's like 50 cents very low per month. It's very low compared to the market. So that's where the opportunity is for someone that will come in and do whatever it takes necessarily. You know, whether it's like just repaint the building, right? Paint it to black and white so it's kind of pop, because right now the color it's more like a brown, kind of older trend color. Sometimes you'd be surprised if you just do a very minimal and then push the rent up, because the tenant, just like multifamily, they couldn't find anywhere else nearby that's kind of at this low rent, right? So you push just enough for them to not go to another property, right? And then that's where you can capture your return, like a higher return. So
So this is interesting. You bought this a while ago and you've held it for what, 10, how long?
Maybe 15 years, seems like.
Yeah, over 15 years.
So you refi once?
Yes.
Okay. That's great.
So yeah, I mean, investors already got their money back. You know, they're happy with, because the cost basis was much lower at that time.
Yeah, they got their
And-
money back, I think the 5th year. So it's just cash flow.
So Rashada wants to buy your property.
Well, yeah.
I sure do.
It's very cheap, but there's a lot of opportunity for sure. I mean, it sit on the hot corner behind a gas station. But just basically just want to share how we looked at retail, right? Because it could be different properties, but the process is the same. We looked at the market, we looked at the current rent. Is there a spread? How big is the spread? Is there any opportunity where leases? Because some of the property, like there's also property that's a fully leased but newer, but the tenant have 5 or 10 year lease. But if you invest in those type of properties, it gives you stable cash flow, but it's not going to generate you like a good like 15-16%. The reason why is because the tenant had tied up with a longer lease term already. There's nothing you can really do to, put pressure on rent to keep going up, because if they sign like a 10-year lease, the escalation is already built in. The escalation is already like defined, right? What is it, 3% or 4%? Whereas if you have the tenants that are coming up due in the next, year or two, then yes, you can inject capital, repaint, or refacade, bring the building taller and start putting pressure on rent growth. Then that's where you can get the high return faster. I also want to be sensitive of time. I think we're on a time, and we definitely want to leave time for networking and Q&A. Next slide. I just wanted to briefly touch on that. So so the income expenses. So the base rent is what the current tenants are, all the tenants are paying, and then the triple net is what they reimburse you on those expenses. And then if you look at the gross expense, right, the red, just look at the 2 red arrow. So you're collecting 114,000 from the tenant, but your expense is 132. Why is that? The reason why is because there's some gross leases, right? The gross lease, you can't really get reimbursed on the triple net, right? Because people are paying you gross lease, so the gross lease is covering all the expenses. So that's why your expenses is higher than the triple net that you receive back. But in the perfect scenario of a triple net leases, if all the tenants are triple net leases, if your expenses are 132,000, your triple net is 132,000, and then your NOI, your net operating income, will be the same as your base rent. So that's something that I want to kind of point it out. All right.
So what's the cap rate?
Anyone want to take a stab? What's the cap rate? It's pretty easy. You got the NOI, you got a price. No one? So basically it's 247, 267 divided by 4.125 million. It comes up to about 6%, I think.
So is this so did the price go up because Rashada's interested?
It'll be 4.5 now.
Yeah.
But yeah, I mean, like, love to answer any questions and then also leave time for you know, kind of networking and things like that.
Is this typical for retail to sell at the pro forma? Or it's just a pure?
This is not pro forma, this is the current.
Yeah, I know.
Yeah.
So in a multifamily, you've seen a lot is that they renovate 10-20% of the units, and they give you like $1.30 a square feet instead of $1 per square feet for rent. And then they are calculating cap rate based on $1.30 per square feet. And hey, this is a pro forma cap rate. You'll get that once you renovate rest of 80% of the units. Do you see that happen? That type of sales pitch and
I mean, we
happen in retail?
Not frequently. The only time that the broker is trying to do a pro forma is if the building is very vacant, like high vacancy. That's the way, because when you have a very high vacancy building, your NOI is very low. They cannot just use the low NOI and put in like a 6% cap rate and say, oh, this is way undervalued. So that's why they have to do like a pro forma and kind of value it that way. And sometimes the high vacancy retail building, they sell it as a price per square feet. Instead of focusing on cap rate, they said, okay, we're selling this property at $150 a foot. It's way below replacement cost. But it's pretty rare that I see like brokers will pitch in and say, hey, the pro forma cap, and then sell at a higher price. It happened, but not frequently. Most of the time it will only happen in the high vacancy building, like I just mentioned. Yeah.
I mean, it's a harder sell because you're not mark to market in the leases like you are multifamily, right? You have these locked in longer term leases with
Longer term,
fixed
5-year
rent
terms.
steps.
Yeah.
Yeah.
Right.
And then number of the units is significantly less, 100 units versus 10 units, or 10 tenants, 100. Yeah, so.
Yeah. I think one of the questions D Seals was asking, if we are searching for a good retail location, what demand metrics are you looking for? Median household income or traffic counts? If you talk to some of the, brokers or investors that have been in the business for like 30, 40, 50 years, they might just say, hey, it's all about the gut feeling, right? So it's like whenever they go and say, oh, my gut feeling said this is a good property, which is, I think it's kind of somewhat true, right? I mean, just like for you guys, when you guys look at multifamily, it's just, yes, you underwrite it, desktop underwriting, analysis numbers. But sometimes when you physically visit the property, your gut feeling tell, hey, it's like, not so sure about it. So the same thing as retail, it's like the gut feeling is like your vision, how you can envision that property is going to be turned around or things like that. Yes, you want to always look out for, hey, is it going through a gentrification? Is there more like new communities coming out within the next 10-15 minutes where there's going to be demand for this type of center?
I want to add to, the gut feeling is also ingress and egress, right? Can you make a turn into that center, or do you have to U-turn to get there? So there's a lot of things on location, right? We always, for retail, it's location, 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 right? Because it's not where you can be apartment on the backside. It's still location, but it doesn't have to be visible, Retail, we need the visibility, right? So that puts in a lot of factor of like how much rent you can adjust, right? Versus a 2-story retail building, upstairs is going to be harder to lease out, especially in Texas, right? And downstairs is going to be more rent. So things like that. So there's a lot of different factors. We also look at, housing, right? What is the housing trend in this area, right? Traffic count's important too, right? So yes, we can factor all those things, but you have a lot of smaller investors. They really kind of look at location, and they kind of get a feel of like how the things are going to be moving. Hold on, we got a question. Typical, 7 years, amortized out around 15, or 5 to 15. It's hard to get a fixed 15 years. Requirement on down payment, around 30% is what we're looking at, right, Calvin?
In today's market, as you know,
Right.
like lately, it's just I would say 35-40% is the down payment requirement on investment property. Typical loan term is 5-year balloon and amortize 15 years.
Mhm.
Yeah.
What are interest rates at right now for what you guys are looking at?
7% for conventional commercial loan.
And they're
But there's
recourse
some
or
bank that I talk to right now. They're actually through the capital brokers is there's some lenders that are doing prime minus, because usually it's prime rate plus 0.75 or prime plus 1.
Mhm.
There's some lender that's are doing prime minus.
Wow.
It depends on how they get their and the cost of their capital, right?
Yeah.
They may have some ways that they can get a lower cost capital, and some of the bank, if they have a good balance sheet, so they're lending from their balance sheet, they don't actually, they can be flexible in terms of rate, because otherwise it's just hard right now to do like a loan, right? The bank have to generate loans to make fees and all that.
Mhm.
Some of the bank are being creative.
Yeah, that sounds like they're getting very creative. They want the business. Well, I
Yeah.
might have never heard of that. And
So,
are
Cal,
all the loans recourse or non-recourse, or it's a mix?
Yeah, so if you're looking at just a typical like loan from like a banks, it's usually a recourse. But like the CMBS and whatnot, it's non-recourse. But like if you go to independent bank, or just the banks that you see like as you're driving by, most of the time it's a recourse loan.
Sorry, Daniel, I cut you off. What were you gonna say?
No, I was going to ask, Calvin, remember back in when people were being creative and adding these master leases. So if you have a vacancy, and we would pitch where the seller will guarantee a vacant space for 1 year, so they can push their sale price, but guarantee that lease. Hopefully, you can lease it after you buy it, but if you don't lease it, they'll be paying the lease on that vacant space. Do you think if the market shifts and vacancies come back, do you think that's gonna come back, Calvin? People are gonna be creative that way.
I know some of the I've been seeing some of the listings that have like a master lease. I think the investors are smart enough these days, or been spoiled for such a long time, right? Just like interest rate was so low for 3%, whatnot, and like now it's at 7. Historically, it's still low, but it's just we got spoiled, right, for so many years, and any little thing we'd be, oh man, like interest rate so high, and same kind of like the same as the master lease. Investors are smart enough right now. Is that okay? It's only 1 year lease, but I'm paying, basically if it is a $10,000 lease, if you put like a 6% cap rate, So that's $167,000 that I'm paying to get that $10,000. What if after, when if economy like goes, hit the, shit hit the fan, and even after a year, I'm not able to get a tenant, I'm still losing because I'm paying $167,000 to try to get that $10,000, which is not a longer lease term. It's just a 1 year.
Mhm.
So I'm paying $167,000 to make the $10,000, which doesn't make sense.
Mhm.
So I mean, there's going to be some pushback because I was presenting one of the center to one of my investor client. Is I know, I mean, like it's, we're not going to offer that much because of the master lease. We're gonna be reasonable.
I just wanted to mention that because you might start seeing that, and at least you know what it is when you see it.
Mhm.
So.
Mhm. Yeah, we're seeing, multifamily, more seller financing to kind of make, things happen.
And right now, if those property, their loan is assumable, right now, that's where the money is, right? People are talking about that, like, hey,
Yeah.
is your loan assumable? Because
Yeah.
that's where.
All right. Anyone else has questions?
Yeah, I have a question. On the retail space, are you guys seeing like rent concessions? I know obviously in the last few years, right, DFW has been very hot, right, especially on the multifamily space and just in general. And are you guys seeing commercial spaces, rent concessions happening?
Yeah, so the on new leases, for example, if it is a brand new space, a lot of time landlord will give you time to renovate and get open. But as soon as you open, they will start charging you rent. Of course, the depending on the landlord situation, if they know that you don't have anywhere else to go, then they're not gonna give a whole lot of concession because they know like you really need the space. Whereas if there's more supply in the surrounding, retail space, then negotiation standpoint, they might give you more concessions. So it all depends on how the tenant brokers, how experienced they are, and then the landlord's agent, how experienced they are to try to, kind of be more balanced in terms of negotiation. I think as the market softening, right now the problem is we still see a lot of strong demand in retail space, right? Like today, I just got 2 leads, one for medical and one for an office use. But the demand is still there. Businesses still wanted to grow, right? Regardless of interest rates going up. But when business have business, they really need to expand. So the thing is, right now, businesses are still expanding. We haven't seen like businesses is scaling back, right? Your restaurants are expanding. I have some restaurant clients, they're expanding. Like for those businesses that are thriving right now, I mean, they're expanding. But until when the demand started to softening, that's where landlord is going to be providing more concessions to try to secure or get the lease signed.
So yeah, too early to start seeing softening in the market and require tenant concessions.
Well, I think because also what Calvin, you would maybe agree, there's still a lot of 1031 money still moving over until that kind of slows down, right?
Yeah.
So,
Yeah.
all right.
Any other questions?
I have one more about what's a typical vacancy one should expect in retail. I know multifamily is typically 5% that we're estimating. So what's that normal vacancy in retail?
So the good thing about, like I said, retail, you have 4 major types. You got the grocery anchor center that's like, 50, 100,000 square feet, and you also have the neighborhood strip centers, and you have the single tenant. Of course, single tenant is like always, when there's a tenant, it's like 100% lease. Multi-tenant, it's usually occupancy is very high because the thing is the strip centers is usually 8 to 10,000 square feet, 4 or 5 tenants that usually stay pretty full. If I were to throw a number, I would probably say, somewhere from 3 to 5%. But most of the deals that we're looking at that sellers putting on the market is usually, fully leased because that's where they can get the highest price. But if you were to underwrite, if you just need to have a number to kind of put it in that underwriting, it's like 3 to 5%. But when you do that, then you're lowering your value, the price. And when you're competing with other buyers, it's harder for you to get it because most of the time they don't put like a vacancy loss in there. They just like underwrite the whole just because if a property is fully leased, it's like 3 to 5 year lease term.
Makes sense.
Yeah, I have another question.
Okay.
Yeah, I have another question. So you mentioned the demand is still there on leases, right? Are you talking about generally your typical C class or B class retail strip malls versus the class A in Frisco or like McKinney? Like that goes for 30,000 square feet.
Yeah, so retail classification, it's I think there's some difference because you can have a class A location but class B minus built. So you talk about Frisco, McKinney. If you drive, you see most of the centers are pretty full, right? There's slightly, unless the newer one, because as they're building and finishing out the building, they have to go through pre-leasing before the lender will release the money for them to build the building. Usually it's a 50% pre-lease, then the bank will start releasing the fund for them to move dirt and go vertical. And then after they complete, they might still have some vacancy, and that's pretty normal. But for those buildings that have been a couple years or 10 plus, usually they stay pretty full. And usually if there's a tenant moved out, the average leasing time is 4 to 6 months to backfill a tenant in there.
And it also depends on the landlord, how aggressive they are with TI and what the concessions or anything they try to, what's their, I guess, yeah, what's their criteria of the tenant, right? Some people are really picky on what type of tenant mix they want. So they'll deny a lot of applications. So it really depends on your property, what's your goal, and if you want to sell, right? If you want to sell, then you want to find class A tenants. You want to give them TI more to get in and have higher rent so you can just sell at a higher price. So it's all dependent question as well. And some properties are mismanaged. Some of the properties we pick up are mismanaged, so.
These are all great questions. Any more questions?
I think we're good. You want to tell